yeah, you really need to get into it because and I figured she's a good bellwether to what other people understand or don't understand. So this is the risk ladder. And in the risk ladder, is that better? So we'll start off with saying in our first two meetings, we talked about budgets, saving, and emergency funds. This situation that we're going through right now is a good indicator of how each of these things are needed. You know, there's a lot of people, even if you're still working, you may need to have called up on your emergency fund, and it may have become a deterrent to your ability to save, to be saving, which means that your savings, which is a thing, rather than something you do, your savings may be stagnant. But, and others may have had to call on the emergency fund. Let's say again, shows how important it is to have an emergency fund too. Last week we talked about opening an investment account. I recommended people use TD Ameritrade, so we're talking from the same platform. You don't have to, but if you do have an Ameritrade account, some of the stuff we show, stuff that you can look up on your own after we're not together. It just makes it a little bit easier. Most major platforms will give you access to the same funds that Ameritrade will allow you to. The reason we're buying stuff outside of just our 401k and work stuff is because our work funds will only match so much, and after they match so much, the rest of any money that you have that you will invest should be done outside your account, because you can open up different types of accounts that won't have the same retirement restrictions, and that makes sense. But also the funds in your 401k are limited. I talked to someone this week who actually thinks she gives real estate advice, and I asked her what were some of the things she's invested in. And she told me, I don't buy stocks, I just have a 401k. Not realizing that the funds in her 401k are made up of stocks. And if she went into it and looked at it, she would know what stocks are in her 401k. And when we tried to discuss that, she told me I was 100% wrong, because her 401k is made out of funds, not stocks. And even if you just have ETFs and mutual funds, they are
stocks.
Right.
I actually saw something on Twitter where it said a lot of people, and they've heard a lot of people in the Black community prefer real estate over stocks, because for the longest time, for one, we were denied that. So that's part of it. And then for two, it's more tangible and it feels safer.
And both of those are true. Both of
those
are true.
Right. But it's a lot harder to get into real estate because you need way more capital.
And there you have it. So that
Which prevents a lot of people from making money. So you got to start with something else.
Right. I've actually.
But then you can just invest in REITs.
Which is what we're talking about.
Yes.
And a lot of people say, I don't get into real estate, into funds, because they're afraid of getting cheated. They don't know anything about it. But then, like Isaiah said, oh, let's buy real estate. Well, they don't realize that you can get in real estate in ways other than buying houses. And even if that's the way you want to do it, there's such a high floor to getting in. Saying, if you were here in Washington, you want to invest in real estate, you got to have a minimum of 100 grand. I'm gonna share Melody, as you pointed out, that one place you showed me, it was well over 100,000, right?
Which one place? The condo?
The listing that you sent.
I sent you. Yeah. That was like the only thing we found under 200,000, and it came with an HOA because it was a condo.
Exactly. And HOA and condos have a hard resale. And so there's a lot of different things. Even I contacted the agent just to say, what is the HOA? She would not tell me. She was like, if you want to come for a tour, I'll take you on a tour.
We have a good agent. She went through the whole thing with us because we're actively like looking to buy. They were probably conscious about telling you because you didn't look like someone who would actually be willing to buy.
But I don't understand why it makes it a secret. How much were the HOAs?
I wrote it down somewhere. I'm flipping through my little pad. It broke up into like three parts. So there's assessment, which is like the not forever thing. That's like to build up
For a
a
specific reason.
pool. And so that's 233. And then she gave me two different numbers that I'm not certain what each one individually applied to. I think it was like they're both for the HOA, but they went into different like funds. And one was 309 and the other 75. So it was just under 400 is what you're supposed to be paying when the assessment's over.
Right. So 635 until the assessment is over.
Yeah.
So if you're trying to get in, those are very high numbers, and there could be different things that pull you away from it. So as Melly said, a REIT is a affordable way to get in. We started talking about exchange traded funds because the cost and what it gives you an opportunity to be diversified from the beginning. And we talked about diversified emerging markets as a category to start at. So who opened or has an account already with TD Ameritrade? If you did, we're going to go around. You just say yes or no. If you do, or if you put any money this week, how much did you, the optional questions, how much you deposited, what two funds and the bills did you buy? Was this a sacrifice to your budget, or do you always contribute to it? And anything you want to tell us about your experience. Whoever would like to start first, introduce themselves and then answer the
Wait, I can go first. I have an account. I have about 10,000 in my TD Ameritrade account, and what I bought this week was I kind of consolidated into a bunch of REITs, actually, because it looks like the market's crashing even more. Like we could be in for another really big dip. So I kind of consolidated. A few of them pay out monthly, which was intentional because we don't know how long the dip's going to be.
Monthly dividend.
Yeah, so I got a few that pay out monthly dividends. So that way, because if you do quarterly, it's almost like consolidating for no reason because I'm not going to get paid except once off of that. But I figured, yeah, the indicators look like we're in for another like big bullish week or bearish, whichever one. We're dropping this week, it looks like.
Right.
So I consolidated a lot of my risk for now. Wait till maybe after November when we have a president and a leader of the Federal Reserve who doesn't swing the stock market with a single sentence.
Right. Do you have do you have any ETFs?
Yeah. Is it? I think so. I have like a few like Vanguard. I think they're ETFs.
Okay.
Like just different like. Yeah, I don't know if they're technically mutual funds or ETFs or what, but yeah, like Vanguard type things or indexes.
And do you have a normal addition to your account?
Yeah, I do $10 a week as a recurring, and then I'll add as I want to or
great.
decide to. For a minimum of $10 a week.
Great. And I'm not sure who all still on. just because you have money going into your account doesn't necessarily mean they're going into a specific fund every week. Like myself, I have a weekly deposit to my TD Ameritrade account, and I do what Isaiah said. I look at the market, I think about what's going on, and I just know at least that money is in that account. It's not in my checking or savings. When I go and I check my account, occasionally I'll say, oh, I have this much funds built up. This is going on. Should I buy something or should I just let the money sit there? Because as we'll talk about today, cash is one of the assets that you should have. And it doesn't have to be your savings account or your emergency fund. It could be in this investment account waiting to be invested in something in the future. A lot of people thought that any money you put in your investment fund immediately means you're buying something, and you're not. So it's smart to have money going straight there, even if you're not saying where it's going to go, but it's sitting there for future use. All right, who'd like to go? Maria, Montoya, Melody, either one of you?
I guess I'll go next. I straight up could not figure out what was wrong with TD, so low-key I gave up and just started focusing harder on Robinhood. I'm sorry.
Robinhood's terrible, though.
I'd love to get a managed account. I have not had any problems with Robinhood, but they could be under fire because a very dumb young man lost a lot in stocks and killed himself, and they're trying to pin it on Robinhood, which I think is kind of dumb. Because the family's saying that they shouldn't have displayed his balance, and I'm like, he's a consenting adult. He signed up for the investment app. Like, they just showed him the finances that they were supposed to show. What did they want the app to do? Lie?
Do you know anything about trading options, Poops?
Like, what do you mean?
Like
doing limit sells and stuff?
No. Options is a whole different thing. Like a call or a put option.
Are you talking about options or
margin? An option.
Okay. What do you want to talk about?
This man was trading options. So when you trade options, you trade in values of hundreds of stock. Also, the way it works is like when you buy the strike price, you're buying the right to buy or sell 100 stocks at that share price.
Right.
He's paying a premium for that. And basically what happened was this dude ended up trading a bunch of options. He had set up a bunch of these options trades. And so technically his account was negative 700,000 or something like that.
Yeah.
But he had not his options had not worked. It was all like on principle. Because basically, he had quote unquote bought say 1,000 or whatever shares of a company, but he hadn't actually. He had paid the premium for that many shares.
Right.
But it looked like his account was that overdrawn.
He was acting like a hedge fund manager, and he didn't know what he was doing. And so that's why
he was a 20-year-old boy.
Exactly. Well, okay. let's move on. Mel, try to get yourself the account. You and I have. Let me make sure. You and I have already talked about this. You owe me a $25 a month investment in TD Ameritrade based on telephone. Your telephone bill that I'm covering $25 a month of was for you to start a TD Ameritrade account. Live up to that. Okay, Maria. Did you have any input before we move on?
Maria is not on here.
I'm sorry,
Angie. And unfortunately, I got super busy and I wasn't able to do it. So I got to do this homework over the next couple of days.
All right. And it's built in because I knew that there would be some people who didn't do it, but they would hear these conversations and see what's the benefits, what's the like. It's uncomfortable, and some of us didn't have time or we didn't have the 100. What the homework was to muster up $100.
Yeah, it's not the fact of I didn't have the money. No, I have the money. It's just that I didn't take the time.
Well, that's what I'm just saying. say, I'm giving you the homework of what it is to take $100, open up an Ameritrade account. What we asked was to go in, look at their exchange traded funds, go on the diversified emerging markets as the category, and then to buy 2 funds. I don't care how much you spend. You don't have to even spend the whole $100, and you may not. It's just buy at least 1 fund in 2 different things.
I have to call you on that so you can
Okay,
give me the steps to do it.
no problem. And I'm going to close this. Well, I don't think I really need to. Yeah, because of what we're going to talk about next. So we'll just take a few minutes in that to say, like, so this was an account I opened up for Delonte on Ameritrade. As you can see, it shows he started out with a value of $113.72. As you see here, can you guys see my mouse? Yeah. So cash and alternatives, what's available for withdrawal, what's this total position value, and the available funds for trading and non-marginable funds. He has no cash because all of it went straight into investments, so that makes sense. So that's his total position. Under these positions, what he has is, I bought, so 5 shares of BlackRock Entertainment, 5 shares of Emergency European and stock, and this is an EFT. He's got 1 share of that. Then he's got 1 share of this QED and 1 share of this Charles Schwab Emergency Emerging Markets Diversified Fund. This was the market value from the time I took the screenshot. This market value is also the price that he of 5 shares. Today I took the screenshot. This was the opening price. That was the current price at the time I took the screenshot. So you can see for this day, that stock is already up 7 cents. Not anything big, but I'm just explaining this. Like I said, I wish Chelsea was here because I sent her this screenshot and she's like, this is so confusing. Oh my God, Dad, can you please explain this to me? This is too confusing to understand. Which goes back to what Isaiah said about real estate and us not getting into funds. Some of us, this may seem simple, but everything is confusing the first time you look at it. It reminds me of being in the Navy, and we had a young lady trying to use the copier, and it was a complicated copier because it had a bunch of buttons. You could scan to people's desks, you could print from it, you could copy from it, you had to put in whether it was color or not, so forth, so on. And she didn't understand how to use it, and the other people were laughing at her. And I was like, now you gonna tell me that the first time y'all tried to use this computer, this printer, it wasn't confusing? And everything gets simpler as we go. So it's not a big deal that she was confused by it, but it says this is why we're taking the time together to try to unconfuse it and avail ourselves of these different opportunities. So I'm going to log into Ameritrade for a few seconds. We're going to look at this stock ticker QED, which is a hedge event-driven tracker, which is kind of similar to what you guys were talking about. This young man, he was hedging his bets by trading options, and he was trading options on margin. As I log in, who knows what any of those terms that I was just talking about mean?
I know a little bit about option trading, but not a lot. I just kind of dabble.
So go ahead and tell us what you say options trading is.
So options trading, as I know it, is basically paying a premium to buy or sell 100 shares of a company at a given price. You make or lose money on basically like, so if a stock is $5 and you think it's going to go up to $6, you might pay a premium of 50 cents a share for the right to buy 100 stocks at $5, knowing that you think it's going to go up to $6. I don't know if that makes sense how I'm saying it, but that's how I think of it.
Right. So here's the definition. Options trading is a type of trading that is based on contracts. You, the buyer or seller, are making a contract saying it's defined. These contracts give an option buyer the right, but not the obligation,
Right.
to execute a trade. Options trading can be quite risky, but also beneficial in volatile markets. Most of that extreme volatility that we saw in February and March has worked its way out of the market, which why options trading is usually done by day traders, people who can sit in front of a computer and watch things happen as they occur. You can't try and trade options and say, I'm going to put this trade in, go to work, and when I get home 10 hours later, we'll see what's going on. That is a recipe for wanting to commit suicide.
Yes, unless you do further out options. When I do them, it's at least a couple months.
And well, then that's called
that reduces the volatility.
Well, then we say hedging, where you're buying and selling shorts and long. Where say as I buy, if I think that because of people starting to work at home, that I think all this Logitech equipment, videos and stuff is going to make the stock go up. I can say in February, when you release earnings in March or April, you're going to be way up and people are going to buy. This is a gamble I'm making in February, and so I buy you short so I can sell long. So I'm telling you, I'm willing to buy this stock from you, but not pay for it today, which is an option.
Right.
Your stock is selling at $20 a share. I'm willing to buy it from you, but I'm willing to give you $2 extra and pay you $22, even though it's currently selling for $20, if you're willing to wait till April 15th to collect the money.
Mm-hmm.
Okay, so now it looks like I have these shares. Because I could say I have 1,200 shares from you. But I owe you $22, but you can't collect until April 15th. On April 13th or 14th, the 13th earnings come out and the stock is at $35. I put up 1,200 shares up for sale, and I get $3,500. I get $35 a share, and I say, well, Isaiah has those shares. Isaiah, give them to me. I get them, and I give you your $22 a share, and I keep what's in between. That's a hedge fund. What hedge fund managers do. It's what long and short sellers do, but options tend to do it in a very, very short period of time, which is where that term day trading came up. I have done it in the past shortly, where you might buy on margin, which means to buy on credit, where they're taking multiplying the percentage of my account and what it is worth, and basically loaning me money at a very high rate through Ameritrade. I might buy 10,000 shares of something that's worth 89 cents and then sell all 10,000 shares when it's selling at 94 cents and say, ooh, I made 10,000 nickels, but I'm trying to get in and out the same day. It's very risky. I don't recommend it. If you're not sitting in front of your computer watching, because from 89 to 94, it could have just as well went from 89 to 81 cents. Now I owe 9 cents times 10,000.
Yeah, that's like, I've only done a couple. I got a tip on Roku before that shot up.
Right.
And then I have an active one for like a few months out for McDonald's. For when the price. See, and I don't exercise my options either, so that's why I buy them further out. I buy them like if it makes sense. Oh, that's the other one I did. I did MGM right before the casinos open. Like, of course, the value of the stock's going to go out. People are going to freak out. But you buy the option for like 3 months out, then you just sell it, let someone else deal with it after that, once you make money off of it. I would never try to get to the point where I'm getting close to the options expiration date.
Right. And I don't buy options because it is risky. And because of my age and my risk tolerance.
Right. And some of those, it was like Roku, it was like the very beginning of the rumors that Google was going to acquire them. And it was like starting to tick up. Then the rumors, I bought my option, the rumors picked up and the stock like went on fire.
All right. So we said we're going to look at stock ticker QED just quickly, talk about how do you evaluate stocks. And this is because unlike Isaiah, I don't have a tip person. But what he's saying tip though is really public knowledge.
It's really, exactly. Someone who knows more than me posted something and let some of us other people know in just enough time for us to do something.
And a lot of times, like you just said, by the time you know, who doesn't know?
Right. That's the issue. That's why one of the big things is like, you should never buy a stock you hear about on TV. By the time you hear about it on TV, it's already shooting up. People are overbuying it. And by the time it's on TV, it's way too late.
Exactly. And by the time you see it and get to it, and they're talking about it, all the value has been bought out of it. The company might still be going up, but where you get into it might be really hard. So here's QED. Again, when you're looking at these, can you guys see this well?
Yeah.
All right. So one of the things you want to look at is the performance category. Like I noticed this says Morningstar, and Morningstar is a reliable rater of different mutual funds and ETF. So you can look and say, oh, well, Morningstar over here in their wrap up, they say this here, you got short, interim, long, low, medium, high. So it's a short-term thought hold for some investors, or this is a short-term evaluation that's being made because it hasn't been around for very long. That's how come there's no 5 or 10 or 20-year chart, because it hasn't been around long enough. Now, you see the risk is above average, so it's a high risk. But look, the return is also very high. So you got to say, what do I want to do with this? Again, in a market now with a lot of volatility, where people are hedging their bets, buying and selling, this means that our manager has to be active. So you know that the fund manager in this is very active just by the word hedge. And it's an event-driven index. We have a lot of events going on right now. So he or she is managing this fund by looking at world events, not just trying to get into one sector and being docile in it. 80% of its net assets are being invested, and they also loan money out of this fund, which means that's a very stable market of being able to draw interest back on lending, which is why I chose this account, this one. On the Morningstar Index, this is a 5-star rated fund. Because this fund is so young, that means they must have not just performance, but also what they think of the fund manager. I can't be on the computer looking this stuff up every day and individually buying stocks and trying to match this person. But these trusted experts who don't have anything to do, so Morningstar has no financial interest in the companies they rate. So they are motivated to lie and say Bobby's doing good because Bobby's giving them $10 to say it. So that's why they can be reliable. They have, since June, they've had the Street, which is another rater, said they recommend that this ETF is a buy. So a lot of good news about this one. And if you look down, keep going a little bit further down, you see performance-based, where they're at. As of March, they're down 7.84%. But that's actually low when a lot of people went down 30, 40, and 50%. So negative numbers aren't always bad. Saying, hey.
More. Even Exxon dropped like 70%.
Correct. So when you say in a market where people drop 60, 70, 80%, and you lost less than 10% of your value, that means you were actively performing stuff to prevent further loss. I like that. And my fund manager do my work for me, because that's not what I get paid to do. I get paid to counsel people on their mental health. So that all looks good. And actually, I'm sorry, the stock is 5 years old, but not 10. So since inception, they're only up 3%, but that's not bad for a mutual fund. Sector breakdown, when you're looking to buy, Maria, you can look down here and say, what kind of stocks are these companies having?
Uncle Paso, if you keep calling me Maria.
Sorry, because she's been texting me a lot this week. She was texting me a lot this week, going off on Cornell. So you'll see what are they into. 22% of the stock is technology. Technology went way up at this point. Sensitive, I don't know what that means, but he got 41% of it in there. In our defensive sector, 35% of this is defensive to market breakdown, and they buy that through consumer defensive goods. So buying stuff that consumers will always need, like food and healthcare. Here's healthcare and utilities. You're gonna need utilities no matter what. So those things will not typically lose money. At the worst, they'll start to go zero rate. But these are things that even if they raise their price to make their profit back, a consumer can't get away from it. Your rent goes up, you're always gonna need a place to live. Your gas bill goes up, unless you're gonna start pulling wood off the walls and burn that instead, you gotta be heated. You can wrap some blankets around you, but even if you keep your heat down, you still got a service. So those are some of the things to think about. Cyclical real estate. Real estate is a cyclical thing. This is a way you can just cheat and say, what do each of these different parts go into? I didn't know real estate was cyclical or financial services. Yes, financial services is, because they do a lot of investments and borrowing at a time where people may borrow less or interest rate may change. So that's how you say, okay, now that makes sense to me. By looking at this stock, I learned something about banking. And then it's got the actual listing of the top 10 holdings that they have. 37% of this ETF is made up of Vanguard short-term corporate bonds, which means they're making most of their money by short-term lending to different corporations. Remember I said this is a time where borrowing, even if we don't lend it out, we're putting our money into a fund that does lend it out. And so those businesses are being funded and paying it back. And that's a low risk type deal. We also have a Blackstone senior loan ETF. We have a short-term corporate bond ETF, which means they're not borrowing from the Federal Reserve at a lower interest rate. They're borrowing from us at a higher interest rate. So those are good things for you to know what to look at when you're trying to figure out what do you want to buy. Again, you got your rating and risk. So they said the risk is above average, but so is the return on this. And then we'll look at the 5-year chart. because we know it's greater than 5, but less than 10. So there's the chart of how it's performing. We see it's in an upward rate. And all these beautiful Ds, what do that stand for?
I don't know what those ones are. Oh, is that what the dividend markings are? Okay.
The D, I put that on the chart. So every D shows when the dividend is played out. And if there's an S, that S is to show when, I'm sorry, I'm trying to see if there's other participants trying to get in. Nope. An S will show when the fund had split, and it hasn't. So there we go, our look at this fund and why we chose it. But also just saying, if you're looking to try to say, what should I spend my $100 on, or what kind of diversified ETF do I want? And ETFs are usually a long-term hold, should be, or moderately long-term hold. How do I pick which one I want? And of course, you also want to be cognizant of, you know, what you're buying and how much you have, what the stock price is. So for the account that I was showing you with Delonte, he has 1 share of that. And that's based upon, he only had $113 to spend. And that does pay a dividend. So as Isaiah was pointing out, it's nice to have something that's, you're not waiting that you only make money when you sell it. You want something that's going to pay you to hold it. And you plant a little seed right there. All right. So overall, we know that investing can be daunting prospect for beginners, and there's an enormous variety of possible assets to add to a portfolio. There's a lot of different strategies. We already talked about a couple: hedging, we talked about options, we talked about buying and trading on margin, and each one has its own type of risk. And we're telling you how do we mitigate risk and not put ourselves out there. One of those factors might be our age. Other one is how much we have. Other part might be how much knowledge do we have or don't have. Any other factors that other people use when thinking about where they're going to put their funds and how? Speak up, people. Some of the things that you should think about.
Sorry, I missed the question. What was it?
Saying, think about all the things we've talked about or that we haven't yet mentioned. What are some of the other things that we take in, that should be taken in consideration when thinking about what to buy and how and when? I said some of the factors might be how much money we have, how much we already know or don't know about a thing that we're thinking about, our age, so forth. What are some of the factors that you guys have all been using or think you should use?
I like to look. Sorry, go ahead.
I'm sorry, I just said, how much of a risk are you willing to take?
Risk mitigation is a good term.
Yeah, and I like looking, especially now is a really good time to buy into stocks of companies, basically just that you heard of, because we've already been through one recession in the last 20 years. Those companies all made it through bigger and stronger than ever. So that would, for right now, I'd say for beginners, that's probably the biggest thing, is take something like, I don't know, for example, say if Coke is way down, like just buy Coke because you know it's going to go up. But the risk is the biggest thing, and I would say just age, balancing between age and risk. So the older you are, the less risk you want to have. The younger you are, the more risk you can typically afford depending on your income situation.
Okay, that's great. Income and risk are kind of married because, like you said, when you're younger, you have a longer period of time to create income.
But you
Now,
make less income typically.
no, I'm saying the younger you are, the
Right,
longer
right.
you
I'm saying you can tolerate that risk, but your income is also low in general, so that hurts it though.
Right. How much you can put in investment because you got low income, you have low amount of disposable income. And your disposable income per se is what you're investing. Because I think of disposable income is income that you don't need for daily living or that isn't going into a emergency fund. So if I'm making $1,500 and my budget and emergency fund comes out to be $1,300, I have $200 worth of disposable income, and that's already in your budget. Transportation and entertainment and stuff should be part of it. So now I can say how much of my budget of this disposable income should I now allocate to monthly amount of saving. And like I said, if you're older, you may have a higher income, or I even use me for instance, as you get older, you start saying, oh, you have less financial obligations to take care of kids. Your house may be paid off or not paid off, but you start saying, I don't go to the casino all the time. I don't go to the club as much. So now you have greater amount, the things that I write down for entertainment are less than I would have if I was 20, 30, or 40. I don't have child support. So you start saying, how do I reallocate funds? It's harder to do that when you're young, to say, I only want my entertainment fund to be $30 a week instead of $50 a week, because, I'm not going to bed at 9 o'clock. I'm going to bed at 1 a.m. I'm coming home from the casino at 6:20 a.m. So whatever it may be. But you talked about up and down in prices, and I want to dispel that rumor. We don't have to buy in just because the market is down.
Right, we don't have to. I'm saying it would be a good way to see that money go up.
Right. If you think, right. And so sometimes you're buying into a company's value. You don't want to, nobody wants to overpay. Right? Most
of these companies, the value that you're getting at this price level makes it an extremely good investment. Right. You could find value in a regular market that's not crashing that hard, but you will find extreme value right now in long-term investments for these companies that will make it through.
Right, and some of these companies are already overpriced, even whether they, and some of them have value. And so when we look at it and we say price earnings, I don't know if these ETFs have that. I don't know, I'm sorry for not knowing that.
It'll probably still have like earnings per share.
Yeah, that's what PE stands for. Yeah, PE.
Yeah.
So your PE rating, see, here's a BlackRock. Its PE is 0. So I'm gonna go to a different account and look at a different style. And so when you're looking at that, that might tell you, is a specific stock. Okay, is a specific stock fairly priced? Here's Delta Airlines. I don't know if it is or isn't. So one of the things you want to look at is this PE ratio. Currently, this PE ratio is a relative valuation measure used to determine if a stock is expensive in relationship to its peers. So this one is 5.48. One of the things you typically want that PE to be 15 and under. Saying, is it trading at how much per earnings? You want it to be trading at less than less than or equal to 15 times earnings. Other than that, the stock is considered to be expensive. But the main thing is, I want each one of you to answer this. When is the best time to start investing?
Yesterday, 5 years ago, soon as possible.
Yeah, I'm overdue. Past due notice.
What's your answer, Melody? Or did she leave?
It looks like she's still in there.
Mel? All right, whatever. The best time is yesterday. The best time is now. Because you never know when the stock is at its highest or its lowest. So you have to think about continuation. Which one of these stocks will continue to bring value and, most of all, dividends? That's how come, even though the tech sector boom was really great, it also sucked because all of those funds were going way up, way up, way up, way up, but not giving any dividends. So the only time you made money was when you sell. And, you know, you have a propensity to say, oh, darn it, here's this stock I bought for $40. It went up to $400. That's awesome. 10 times what you paid for it. Then it goes down to 300. And most people would be like, I'm not selling in this stock until it gets at or above $400 again. And then especially if you talk about a long-term hold, all of a sudden, 7 years later, you're looking to sell it and it's at 240. You made a lot of money, 6 times what you paid into it. Your mind just keeps thinking about when you saw it at 400. And that kind of sucks because you've never got anything back from it. If you had been getting some dividends over those 5-10 years, softens the blow a little bit. And companies that give out dividends tend to have high-end, longer-term investors put their money in it. And the benefit to you is the benefit to the company. People who put their money in a company and leave it there for a long time means the company has less volatility, less talking heads talking trash about them, and therefore longer sustainability to stay in business. Which is why we have like CDs. You know, you have a CD instead of a savings account because the bank can feel comfortable giving you this interest rate because they're like, yes. You open up a $1,000 CD, they go, I know I'm going to have this amount of money or should have it for a year or however long the term is. And I know what I can do with this money and not be afraid. Lamont's going to say, you know, give me my money back. And now I don't have this money to invest and work with. That's the same thing why a lot of companies give out dividends to entice investors to get in and stay in for a longer period of time. Give them more value. So investing requires saving money to invest. You know, we talked about budgets. It has to be in your budget that you're going to invest. How much per week, per payday, or per month that you're going to put in. You can't say, I'm going to use someone who's not in the room. On the first session, we said, I asked everyone to give a 1 year, what financial goal that they wanted to achieve this year. I'm going to tell you, only one person listed a goal that met the criteria of that question. Other people were saying stuff like, I want to save $10,000 a year. And I go, how much are you saving per month? Oh, nothing right now, but that's where I want to get to. And I was like, you know, so the point is we have to have goals that we're working on and then goals that we're working towards. Right now, if you're not working on a goal to financially save, you're not really working towards that goal either. You got to figure out what in your budget can you sacrifice, can you identify, or even if you just say $10 a month, something should be able to be going to that account every month. And it shouldn't just be, you know, Robinhood or Acorns, where those are great ones where they're saying we're going to do the extra change from your purchases. But you should have a line item in your budget that says, this is how much I'm putting in savings every month. This is how much I'm putting in my investment account every month. Remember, your portfolio needs to be adjusted periodically based on life changes, like we said, loss of work, increase in pay, purchases that we want to make. Maybe we say, I don't do this much anymore. So where am I going to get this extra money? Where am I going to put the extra money? Am I going to, if I cut off my cable and no longer pay $170 a month, and instead I'm going to get Hulu and Netflix and pay for internet only, and that saves me $50, you should be thinking about, what will I do with that $50? Will I put this into my portfolio? That is an adjustment. People think an adjustment means just what are you buying and selling. Adding or subtracting how much you're investing every month is an adjustment too. And remember, the focus should be long-term. Long-term is a relative term. Long-term for some people could be, what am I doing over the next year? But you should also say, what am I doing in the next 3 and the next 5? You should not be making a bunch of investment decisions about this week and this week alone. Got to have a long-term plan with short-term actions. And again, that's also a relative term. We talked about investment education is essential, and that you should rely on sound recommendations from experienced investors. Now, we talked about people who are on TV saying, buy this, buy that. I 100% agree in watching shows like that. I'm not taking them for gospel and not doing everything they say, but gleaning the information that they have about why they think something is going on. And then, like, one of the things, I look at Jim Cramer every now and then, not much, and I listen to what he's saying because he said where the market is going. And he's telling us after the fact and trying to act like he's giving us future event. But he's, to stay right, he's basing 90% of what he's saying off of what's already happened. But I can say, well, this still helps me to think. I can take this information and think about the future, as well as say, hey, maybe this, whether most of the value is already gone, this might be a good long-term hedge. Because every now and then you hear that. So I recommend find a source that you like and listen to it. I like listening to the Marketplace Report on NPR every day. It's part of my drive. It's lucky that it fits into my commute. So while my commute is going on, they talk about stuff, and they talk about the overall economy, not just stock tips. They don't give a stock tip, but they do talk about what's going on. So I recommend you find something that fits in your schedule, that you enjoy listening to, that you find benefit. Listen to it, but you can't listen to just one thing. Listen to the thing that you enjoy the most, but you should be looking at something at least once a week and just staying bought into it. That does not mean opening up your account and going crazy over your investments every day. I mean, I don't even hardly log into TD Ameritrade, but I do listen to other stuff. Is there anything that people are listening to that helps them stay in contact with the market and the economy, which we know financials and the economy are different, but we should be trying to stay in tune with both. what are some sources of information that some of you guys are using?
I follow people on Twitter who chart the Dow Jones and S&P each day and give their opinions on like how they think the market in general is flowing based on the chart and the trends. That would be what I do. They're analysts who do it themselves, and they just put their charts out and say, well, it looks like the market's bearish or bullish, or like could be trending down in the next couple weeks or trending up.
Okay. I know, Melody, you said you listened to that Young Millionaire, right?
She might still be gone. I think she might have left her phone or something.
Right. Well, the reason I brought up this guy that Melody listens to, he makes a lot of YouTube videos.
Okay.
Just like me, he's saying what he's learned from his experience. Neither one of us are trained, paid experts. So, but he does have a financial gain from it. I don't. It is good to hear from people who are actually doing it, who are not being paid to give us information. Because you say, okay, this person may or may not know what the hell they're talking about. I didn't go to school for this. You guys know I did do the business financial management for the Navy course, that for my master's with the Navy, master's level course. That doesn't necessarily talk about investments. However, at
Okay,
50,
excuse me 1 second. So I'm noticing on here saying recording, because I really couldn't hear good. I had to walk inside of the store. So like the last 10 minutes, it was like I got every few words. Can I go back and listen to it?
I think you can.
Because I do see it say recording, but I don't know how to get access to it. We'll talk about that later. Keep going. Okay.
Okay. So I say you can always get experience from people who have gone through this and have gleaned some information. The big thing of all of this is to say, do not limit your education information to just one source, especially not to just people that you say, oh, I agree with this person and this person or this thought, you know, because that's kind of like what's going on with our country, Republican, Democrat thing. You got to hear from each way. And investing is even more so because there's so many different strategies. There's so much information to just keep an open mind and don't limit yourself. If you hear something about something and you got 20 minutes to listen, why not? And don't dismiss your ability to research and understand for yourself for free, and sometimes even by yourself. Like I said, being able to go on Ameritrade or another trading platform that you're using and said, hey, how do I look stuff up? Here it is. You have a, here in Ameritrade, they have this. Planning and retirement. They have planning and retirement overview, goal planning, income estimator. You can find an advisor if you want to pay for that or not. You can research different investment approaches. This is all free. This is why I recommended this, because I don't want anyone thinking that I'm that talking head that I'm going to be on here every Saturday saying, buy Coke, buy Pepsi. Nope, not going. Because A, that's not what I do, and B, if it makes money, you feel great. If it don't, you be like, oh, why'd I listen to Dad? Why I listen to Lamont? And we all have different investment strategies, risks, and styles, which is why we talked about that. But we will talk about how to come in and use these resources, how to track and look, which is why we looked at that other stock QED. So if you're buying stock or a fund in accordance to what we said we're going to try to do, because we'll be evaluating another fund next week, and we won't be making our next group purchase or recommendation of a group purchase until July for people to get caught up on this. and to buy into something, and it is diversified emerging market. The reason we did that is because based on several trusted sources and experts, this is what's, just like we talked about real estate, this is an area that's going to hedge us against losses over the coming years based on all the factors that we're seeing now. Decreased production, rising markets overseas, diversification as new businesses emerge, and we try to figure out how these existing businesses will now come about with fewer customers and so forth and so on. And diversified marketing usually fills up a lot of pharmaceuticals, which are beaten a path to trying to get a current hold on this virus. You also have research and ideas to say, hey, here's how I could research other stuff. Again, this means that you're more reliable on different trusted platforms and not just yourself and not just me. Ameritrade does not benefit from you knowing this. They want you to know this so that you can use their platform to invest. They are not charging fees and commission, but I believe you can buy stock in Ameritrade, and that's where they make their money. Me and Melody had this conversation, and she was absolutely right when we talked about knowing how people and companies make their money, because nothing is for free. And it's not a bad thing that they're making money. You're trying to make money. Them making money from running their business is exactly what they should be doing. Know where you fit in it. Know where you fit in it. You don't want to pay excessive funds or not, and knowing their business model, so you can say, do you believe in it? Should you be a part of it? And the things that affect it, like Isaiah and Melly, you guys were talking about Robinhood, and actually knowing in real time an event that may or may not affect their profitability, as well as their status and their reputation going forward. Here in this research and ideas, we got all this different stuff that should help alleviate some risk and some of that uncomfortable feeling. And that's what why we said using this same platform, people can weekly ask a question that other people in the group, including myself, may be able to answer or talk about from the same page. But that is a way, even though that platform is providing it, you're doing the research, having to understand it yourself, and we want to build those skills. When consulting professionals look to independent financial advisors who get paid only for their time instead of those who collect commissions. When I first started trading, I still have an account with them with Solomon Smith Burney. They put me in a lot of Solomon Smith Burney mutual funds that they managed because the financial planner who we were working with was getting paid to put us into those funds, as well as his company was deriving a profit from it. So of course, there were better performing mutual funds, but he's selling for his company. We didn't know that back then. You know, that's 1993. I was in my young 20s and I had no one to help me. And all I knew is that mutual funds were a good place to be. That was the buzzword back then. And we did what the financial planner told us to do because we thought that was the right thing. We did not know that Larry Toot was steering us into company stocks and earning more commissions for both him and his company. By putting all our money in their funds, he was getting paid twice, well, actually 3 times. He was getting paid by us for his time. He was getting paid by bringing more money into his company's stocks. And then he was getting paid a commission for every sale of company stock. That was not acting as a fiduciary in our behalf. He didn't have an obligation to do that either. I didn't even know what that word meant. And there was no law to say he had to do it. We think there's laws about it now, but unless you hire a person and write a contract that says they have to act as a fiduciary, they do not. So remember, for this group, we started with buying an exchange traded fund. That was to reduce risk and increase diversity. Because even with few holdings, we can be diverse by buying a ETF or mutual fund. As we showed at the beginning, all those holdings mean that we really have a bunch of stock at once. So we're better diversified than if we just went in and said, buy 10 shares of Pfizer Pharmaceuticals or Disney stock. Or even if we bought 1 share of 10 different stocks, this mutual fund was better diversified, because if we bought 10 shares of different stocks in pharmaceuticals, we're slightly diversified by company, but we're still all in the same category. So like I said, take the benefits of mutual funds and ETFs as a good starting point on how to diversify, just like REITs, because REITs have a lot of real estate holdings in 1 share, which is why that's our next area that we're going to talk about. It'll also be our next area of purchase. We'll do that in July. So sticking with index funds or exchange traded funds that mirror the market is often the best path for new investors, and many of us in this group are. Even for those of us who are more seasoned, we see the benefit of it and have been doing that. You can invest wisely and safely, but remember, investing means taking risks. It's always going to feel a little bit uncomfortable. I was watching the retirement planners last week, and a great quote that one of them said was, if what you're buying and selling doesn't make you feel a little bit uncomfortable, you are not properly diversified. You should have some stock in something that you don't know anything about. You should have some stock in something that you don't believe in, even if 1 share. So I have 1 share in a prison. When, I'm glad that they're going away. But my first thought was, well, if I become a shareholder in this, when they have their yearly meetings and voting stuff that I have to vote on, I'll be the guy to vote. I'm willing to lose my $80 for y'all to go to hell out of business, and because it shouldn't be a public thing. So we can be activists. We can work towards the environment, all through investing, but we are still trying to make money. And we're trying to help, as investors, we can help steer the course of these businesses. So have something that makes you feel uncomfortable, something you don't know a lot about, something that you say, well, I don't use it, but it makes a lot of money. Isaiah talked about Coke. I own Coke because my investor told me to put it in there, Smith, Barney. Even though I wanted to buy Pepsi, and Pepsi would have been a much, much better purchase back then, because I paid.
That's Coke right now.
Right. I paid almost $70 a share for Coke back in the 90s. It's not even selling at $50 a share today. I've owned Coke.
Yeah, see, I just said Coke because everyone knows Coke. If Pepsi was a better, you know what I'm saying? I just threw something out there.
No, but you're right. That's why Larry Took recommended Coke. He told me Coke and McDonald's were the 2 best known businesses in the world, and the longevity of it being able to survive and keep paying me dividends. And he was correct.
Mm-hmm.
But I believe I paid $69 a share before they uncoupled with their bottling corporation. And Pepsi has risen up substantially and split. I did buy Pepsi later, but if I would have bought it when he told me to buy Coke, I would have been much better off. I
think that's one of those examples where by the time he was telling you to buy it, the value had already been bought out of the stock. Basically, and the price had been ran up too high.
Yeah, right. And when you're on the top, other people can gain market share more easily than you. And when they gain market share, who are they taking it from? They're taking it from whoever is on the top. Pepsi was realigning itself. He made that recommendation based solely on reputation and so forth. And he was right in a lot of ways. what ended up happening was we took our income tax return and paid, I think, $69 and some change per share for a couple $1,000s worth of Coke. And I'm saying within like 8 months, 7 to 8 months, which meant that if he was actively tracking the stock, he'd have known this was coming. If he'd been listening to the business world, that they sold off their bottling and a lot of other stuff went all the way down to under $30 a share. Here it is 20 plus years later, Coke is selling at about $47, $48 a share. That's fine, and they're paying dividends, but I paid almost 70. At one point, the stock was worth less than half of what I paid for it, even though it is a long-term, probably never go out of business, dividend-paying stock. And Coke, I just said, well, I prefer Coke, but I prefer making money, so I took his advice. And back then, my only investment strategy was, I don't know, buy stuff I use. I'm like, because I do like going to Home Depot thinking, well, when I buy at Home Depot, I'm paying myself. So I was just saying, just be wary about that, which is why you got to say, I felt comfortable. He felt uncomfortable about Pepsi in comparison. And it probably would have been a wise move to have split that money in half, but bought some of each. That's why there's a joke that says there's a reason why they're called brokers, not richers. So let's finish up talking about the risk ladder. So the risk ladder is an opportunity for understanding the major asset classes in ascending order of risk. Most people do not consider cash to be an asset, and it is. It is an investment asset all by itself. And that's why I talked about even just putting the money in your account, in that trading account, as having it as an asset. It's not in your savings, it's not in your emergency fund, it's in your investment account, and it can later be invested or not invested. It changes your account value. So cash bank deposit is the simplest and most easily understandable investment asset, and it's the safest. Not only does it give investors precise knowledge of the interest they'll earn, it also guarantees they'll get their capital back. You put your money in, you can always get your cash back. You're not investing it, you're just leaving it as cash, whether it's in an investment account, a bank account, or CD, whatever. You can always get your money back, and you know the interest you earn. Every bank account, savings account, whatever, tell you exactly what the terms, and it's always guaranteed. There's no chance of you losing it. So on the downside, the interest earned in a savings account rarely beats inflation, right? We have a lot of accounts that give you no interest, or very low interest. So CDs are highly liquid instruments where you put your money in for long term that don't have negative benefits. For myself, what I did to diversify my emergency fund, because the cash are liquid and I can still have it, I said I put all my emergency fund in the CDs, 2 different CDs. Originally, I wanted to have one $100 CD for every day of the week, till Navy Federal called me and said, listen, dumbass, what are you doing? And I was like, huh, what? Because they said, because I couldn't see them all. They're like, you can't have this. I mean, you can own them, but you won't be able to look at them through your app and so forth, which isn't a big deal. But it kicked off my mortgage, which I needed to be able to monitor. However you want to save your mutual fund, your emergency fund, well, I say the CD, we all know, will say you put your money into this certificate of deposit for a certain time period for a guaranteed interest rate. There are also some high interest rate savings account in other places that you might want to use. I like Navy Federal. Whatever is your local credit union, you should investigate and say, I have if If you have a $6,000 emergency fund, why not a $500 CD for every month? So when you're looking at that, that money is there and it's easily accessible. If you have to go into it, only thing that happens is you will lose the interest that you earn. But the benefit is, if you're not using it, it's there, it's available, and it's earning more interest than just a regular savings account. The next asset risk is bonds. A bond is an instrument representing a loan. They sound very complicated, and they're not. A typical bond involves either a corporate or a government agency, and it gives a fixed interest rate time frame. Most common are the triple E or double E government savings bonds, but you can also go to treasury.gov and buy different bonds. We mostly hear bonds where you're saying about with businesses and this company, this city, this state floated a bond. We can buy into those. You know, it's up to you. The most common for us is us buying, everyday people buying bonds like this. I have a bunch of these in my safe. They will come and give you the month and the year. And like this one, it says Series I, interest ceases 30 years from the issue date. Now, after 30 years, they stop growing. However, when you buy a savings bond, what typically happens, it'll say, you want to buy a $100 savings bond. Well, let's say this 50. All savings bonds are purchased at half of the face value. So $50 savings bonds will cost you $25. Then they will give you a time frame, or what we call the horizon, when it will be worth $50. And so let's say this is a 10-year savings bond. I think that's where they're at now, 10 or 12 years. In 12 years, this is guaranteed to be minimally worth $50. It can exceed that. It will never be less than, it will never be worth less than what you paid for it. And at maturity date, it will never go down to be worth less than the face value. So sometimes you might, if you feel these and you feel like you want to invest in savings bonds, you could buy one of these, but you want to sell it by that 30-year date because it won't grow anymore after that. So then you're just wasting your money. Because the interest rate is low, it may not be worth, you might be able to find other instruments, because you could just calculate, saying, if the maturity date is 12 years, what's the interest rate? Can I get better? And it's a choice. But they're very safe. They're heavily traded when the Federal Reserve raises interest rates, because when they raise interest rates, the return on the savings on the bond is higher. And these are whether you're getting treasury bills, which are a type of bond, or a savings bond. I just put this up because this is the most common and most accessible type. If you get one, they no longer issue them out looking like this. They hold them for you. So as far as estate planning, you have to make sure that your beneficiaries know that you own these, because there's no record of it except for you having it. I own some in the ether world, and I haven't even got letters. They used to send out letters once a year telling you what you have. Now they're like, that's your business, you track it. Mutual funds. Mutual funds become the third one. I told you mutual funds and exchange traded funds are very similar, correct? Anyone know what the major differences are? Okay, so the major difference between a mutual fund and an ETF is the fact of the purchase and sale time. when you go into a mutual fund, and they're both assets made up of several different funds simultaneously. And those several funds simultaneously are a lot of people saying we're going to put our funds together mutually for a mutual purchase. If you're going to buy a mutual fund and you were looking at it at the start of the day and it says it's selling for 20 bucks, you can't buy it at that exact moment. It buys and sells at the end of the day. Whereas an ETF will buy and sell in the moment, just like a stock. Another major difference is that a mutual fund may diversify in as many as 100 different stocks contained with a different portfolio, and they may be across several different sectors. So a mutual fund might just say emerging markets, and they might be in consumers and in pharmaceuticals and in technology and in automotive all at once. Whereas an exchange traded fund will pick a category and trade and mimic across that category because they are an amalgamation of that specific category. So that's the major difference between them. And that's why an ETF is the next risk, the next lowest risk, the next highest risk, because we're going in ascending order. As you go up, the ones that come after other would have more diversity. The ETF has more risk diversity because of what I said about it being traded in the moment. Other than that, it has the same risk category as a mutual fund. And both of them have less risk because of the fact that they're mimicking and diversifying across a bunch of stocks instead of singularly. Sorry, I'm trying to get the video right to see more of the screen that I have up. They'll track the underlying performance of a complete index, not just a few. And that's a big benefit for investors. I mean, like we said, the stock that we evaluated earlier, well, we want to try to figure out what those 10 top holdings were and how to evaluate that, and then to individually buy into each one of those shares. QED was selling for $23. We could not have bought one share in any of the top 10 holdings of that company with just $23. So that's a great benefit for investors and how to hedge our money together and diversify. We got we showed the top 10 holdings of that exchange traded fund, but that fund had 42 different holdings in it overall. Out of those 42 holdings, I believe when I tried looking them up, I didn't look up every last one of them, but only like 12 or 13 sold for less than what that mutual fund had. So that means that we have stock in all those companies that we couldn't have bought individually and taken the time to look up. And then the highest risk factor of all, of course, is stocks. Stocks let investors participate in the company's success via increases in the stock's price and through dividends. We talked about dividends a lot today. I love dividends, love dividends, love dividends. That means if you have stock in a company that pays, and that stock pays dividends, that means you're getting money just for owning them, and it helps you to decrease your price per share. For instance, if I get a monthly dividend of, and no one pays this, but let's say we get a monthly dividend, let's say a quarterly dividend of $1. So that means every 3 months, I get $1 back from this stock. And I paid $100 for the stock. Every year, I get $4. And I have 1 share. At the end of 1 year, my price per share is no longer $100, it's $99. It's just a way to talk about what the value of your stock is. So if I sell, as long as I get $99 back, I either broke even or can make money if I sell for more. Stocks are hard and they show a lot of volatility because the company can go out of business and they're very hard to choose. So that's why it's the highest risk factor. Price goes up, it goes down. Company can go out of business, and they might be bought out. I owned stock in Whole Foods, and they were bought out by Amazon. Amazon, we didn't just end up owning some stock in Amazon. They just bought us out, and then I don't own the stock anymore. So my ability to earn money from that went away. Kind of sucked. That's why stocks, I don't tell you not to buy stocks because I own a lot of stocks, but they are the hardest choices and they have the highest risk factor of the asset classes. Unless, of course, you start talking about alternative investments. And there's a vast universe of alternative investments, too many to list, and they are just that, alternative to the common market, therefore making them harder to quantify and giving them more risk. Isaiah, you got your hand up? Go ahead.
Oh, I have a haircut appointment, so I gotta go. But does it automatically record like Angie was saying, so you can go back and watch the end of it?
I have it recording. I'm not sure how it's gonna work. This is my research for this week. I'm gonna see
and I think you're about done anyway.
Right. Yeah. So
yeah, I just have a haircut scheduled because you got to do that coming up at like 2:30. So I don't want to pull a Toya and drive while I'm listening.
Great. All right. We'll see you next week.
All right. Yep. I'll see you next week. But
so again, we talked about there are many different types of alternative investments, and I don't cover them here unless people ask questions. Then we'll do some research and let people talk about them. Again, this is the highest risk factor is just that. Does anyone, so we got like about 10 minutes left for questions and answers. So as we go into the Q&A session, what kind of questions do people have? I hear someone talking, but I can't understand you. It's a lot of reverb on your speaker. Who's speaking? So I'm gonna turn off the computer. This one. Any questions? All right. Glad to see who did show up. How you doing, Lamar? Can't hear you if you're talking.
Can you hear me?
I can now.
This is Mike.
How you doing, Mike?
I'm all right. How about yourself? So what's your opinion on the index funds versus the mutual funds as far as which one is a better investment?
So in an effort to not pick individual funds for people, we talked about exchange traded funds. So index funds in general, there are several different types. What do you mean? Like, what do I think about the difference between the two? There are several types of index funds.
Like when I look at them, as far as investing in the mutual funds versus the ETFs or the index funds, is the fees. So it looks like most of the time with your mutual funds, you have a higher fee, but with your index funds, it's just an expense ratio. And I believe that what that's from is because the mutual fund is managed and the index fund just mimics.
Correct. So I'm thinking when you say index funds, you really mean mostly exchange traded funds?
Right. Yeah, the ETFs.
Right. So in ETF, and that's why in the risk ladder, we start off with cash being the lowest risk, and then we moved up as the third level of risk was mutual funds. I like ETFs over mutual funds. They're both managed, but there takes less management of an ETF because it follows an index or a category, and therefore the managers cannot command a higher fee like mutual funds do. Mutual fund fees are usually called load, and we want to keep our fees as low as possible. However, people should get paid for their work. They should get paid for that professionalism that they bring to a market. However, many mutual fund managers are not outperforming ETFs/index funds. Therefore, it's not really a great thing to pay. This is our third session, and in the last session, what we did recommend was that, so we're all talking basically from the same platform, is to go into to open an Ameritrade account and to use that Ameritrade account to buy an exchange traded fund, to fund it with at least $100. I don't own stock in TD Ameritrade. I don't make any money from this, even for hosting this group.
I use them to trade too, and Ally and M1 Finance.
Great. So this was the reason we talked about TD Ameritrade. So when I'm doing screenshots from their platform, or even like in today's session, I actively go onto that platform and show things, talk about their research and trading platforms and centers. We're all looking, can have access to that same information. If you're using a different platform, it's somewhat similar, so that's fine. But part of the research as a group, which was a recommendation, was people take $100 into their account and to buy 2 exchange traded funds in a diversified emerging market. You don't have to do that, recommend it. And in that recommendation, I'm gonna see if I can share my screen real quick.
Okay.
And I don't see it there. Oh, let me wait. Yeah, here we go. So you can see my screen?
It hasn't came in yet. Oh, there it is. Yeah.
All right. So I can't see what's up on my screen. Okay, yeah, now I do. Okay. So here under the under there, we did the my grandson's account. Come on. And saying going to, it's going really slow because I got both of these up, and it may have just logged me out from inactivity, I don't know. But saying, how do we evaluate these stocks? But we wanted to talk about what people bought and why. And that ETF is exactly what you said, how the fees are less and typically the performance is the same or better. And so why pay those fees? Why pay those fees if we're not benefiting from it? Why get that load? And so to purchase an ETF, 2 different ETFs at whatever price you want, but we recommend it at least for diversification places, that the ETF is going to diversify us, but to diversify by buying at least 2. Going into the trade stocks and ETFs. And then here that, but before you do that, you probably want to go into research and ideas, going into categories. And so we went to research ideas, ETFs, categories. So that way you can say, okay, well, what categories do I want? We said because of today's volatility and what's going on in the world right now, based on a lot of research that's substantiated by professionals, where we want to go is to go down here to diversified and emerging markets, and then picking which 2 makes sense for you. And so I'm not telling people, hey, this is what you should buy, but saying this area. And then once you get into that area, to saying, what do I want to do inside that?
Mm-hmm.
So here we go, under a fund category was the diversified emerging markets. And then it will update to only show you ETFs in that category once we filter the list. And then you said, okay, under this one, what do I want? And you're picking what was some of the criteria that was important to you in this area of why you want to use that. And in today's thing, let's see, sorry, closed it out. We looked at QED a little bit, but we talked about, never mind, that's not even necessary. I'll just go right. We talked about which one of these that you want to invest in and some of the reasons why you might want to. And for we looked at stock ticker QED. This is one of the stocks that I opened up an account for my grandson. It's a Hedge event-driven tracker ETF that's part of the emerging markets. We looked at that and said, not only are we going to pay less fees, but we see that this, from Morningstar Wrap-Up, which is a recommender and evaluator of stocks, that
Right.
it's an above average risk, but it's also a high return. We see it's reasonably priced at only $21.85. And we looked at saying, okay, even when everyone else was losing 40, 50, 60% in value, this stock only went down 7.84% over the last couple of months, which meant that it's being managed fairly well, because we got an active manager for this, because it's a hedge fund ETF. And then we looked at the top 10 holdings and saying, okay, it does a lot of money that it loans out through Vanguard and some of these other ETFs. And just saying, at the price point of each of these, if you were to look up each of these stocks and holdings separately, you'd be hard pressed to purchase funds in all of them for just $20. Obviously, you couldn't.
Right.
That's another way it's diversified and gave us price value. So when you talk about value and cost and not paying fees, being highly rated, it's a 5-star Morningstar account. Fees and management are listed here. The management fee is less than 1%, 0.75%. So you can look at that. You stated that that was something important to you of what are you paying in fees. And then the expense ratio is equal at 0.78. So when you're looking at what to purchase in these two, if you're taking recommendations, keeping up with the group, that's what you bring up is a good thing that people should be looking at, trying to figure out, well, what 2 ETFs am I buying and why?
Right.
This is fairly cheap. I know at least the top 10 holdings of this company is easily listed, and say, wow, I could do research on all 10 of these. You can also see here in the sector breakdown where it tells you what's in each of these sectors. This fund is made up of 3 different sectors: defensive and cyclical. I'm saying that's where it's putting its money and how the fund is managed.
Okay.
Any other questions from anyone else? Questions, comments?
I know one I've used in the past was IVV, iShares. It mimics the S&P 500.
Uh-huh.
I played with that one a lot lately. Well, for last year it did pretty good, but it's high on the risk side, but the returns usually are pretty good.
Okay. Yeah. And yeah, looking at risk versus reward. And today we also talked about some of the things that where people would say, why are they making the risk choices that they're making? What are some of their own individual contributions and attributes, disposable funds available for investing, as well as age, what feels uncomfortable to us, what's our personal risk tolerance for several reasons. At 50, what's my risk tolerance compared to someone at 20, and what my investment strategy is. Do I want to invest as an activist or solely as growth or earning? So a lot of those different personal things that we have to think about and how we're investing and why. So yeah, when you say you got good returns, are you using a drip for those returns that you're getting?
Yep. Yeah, I'm big in dividends too. That's how I started out buying through ComputerShare, straight from places like Nike and all of that. And then a little bit after I got into using Trade King when it was around, then Ally bought them out, and I just left it in there, and I haven't been using it. I've been using M1 Finance because of the free trades, and then once TD Ameritade went free, I started going with it.
Right. I'm glad to hear that. One of the things we talked about today is so many people particularly people of color, Black people in general, have restricted their investments in real estate. And there's such a high floor to get into real estate.
Oh yeah.
And you know, it kind of keeps you away from earnings and getting somewhere, because you have a lack of saying, I want to buy real estate. I want to invest in real estate, and looking at it as your only or your primary investment tool, and saying, well, I don't have the money to start. And we know it's a durable product. It's the one thing that every wealthy person owns.
Mm-hmm.
That you can guarantee anybody with money owns real estate. But
Yeah.
it's hard to say this is going to be my first or only investment because of what it takes to get in, which is why next week we're going to talk about REITs, because that's an alternative way to get into real estate, as well as we do know real estate is a long-term, viable, durable product, and it is inflation. It is a tool to guard against inflation, as well as market downturns and so forth. It is going to be the next purchase recommendation for us in July as we look at market indicators. But we're trying to let everyone get caught up. This is our third session. Session 1, we talked about budgets. Session 2, we talked about diversified emerging markets, and we made the recommendation for that first purchase to open up an account and make that first purchase. And now we're evaluating an ETF every week for session 3 and 4. In session 3 today, we talked about not only evaluating that one share in that fund. We'll do a different share next week, but we also talked about the risk ladder in ascending order. And next week, we're all talk about real estate investment trust. And in July, we're going to recommend that. Oh, in week 2, we talked about budgets, and we're urging people to sit down and redo if you have not already done. If you haven't done, then do one. If you have done, redo. Make sure that you're saying how much, if not a day or a week or every payday or every month, but something that you are sending to that investment account. Not just say, I'm going to save up, and when I get enough, put it in there. But Ameritrade, you can send money to that account. All these investment platforms allow you that. And we want everyone to find an amount that's right for them. Like my son said this morning, he sends $10 a week to his account. That's his level. And
it'll add up.
Put it into an account every week, into a fund every week. It's just going to sit there until you figure out what you want to put it in. So encouraging everybody to do that and to make that commitment to themselves. That's not a commitment to the group, that's a commitment to yourself. To say, this is that. I have, a budget, and last week, a couple people came back and talked about 3 platforms that help you create a budget and be a better money manager. But everyone needs an emergency fund, savings, and an investment account. When I started investing back in 1992, my investor would not let me put any money in any investments till I had an emergency fund, a budget. And after I came back with a budget, 2 weeks later, I came back with a budget, told me, okay, let's sit down, review your budget. He helped me rewrite it the right way, because I didn't know what the hell I was doing. And then he said, okay. And he made me have an emergency fund that was 3 times my monthly budget. He told me he wasn't going to take a dime from me until I did it. It was the right thing to do. And so we're just imparting that wisdom that we've gained, all of us, to each other, and encouraging us to get started. These trying times right now should clearly let everyone know you need an emergency budget and not just you need both.
And see, what I usually try to do is I got my mom on a plan now. I'm trying to help her out to get hers, and I did about the same plan I had. First you try to save up $500, then you'll turn around and you want 1 month I try to do baby steps. Get 1 month expenses, then 3 month expenses, and then 6 months, and then a year. So I
Right.
like to end up having a whole year of expenses saved up, emergency.
Right. Absolutely. Back in '92, having 3 months worth of living expenses was the recommendation. Right now,
Uh-huh.
I would say 6 months is the minimum and 1 year is preferable. And even today, we talked about once you have that emergency fund, while you don't want, you need it to be liquid and available, if you can also make it work for you. So what I do is I put my emergency funds, I spread them out in CDs, so that way they're something always maturing. So that way I'm earning more interest than just a regular savings account. The money is extremely liquid where I can get it at any time. I don't lose any of it. At worst case scenario, if I need more than one CD, to cash one CD for any emergency, and I had to cash out multiple CDs, I would just lose the interest I was earning for that year. I put mine into
Okay.
1-year CDs. And so that's a strategy I recommend for people with the emergency fund, to put it in some type of high yield saving that you don't have to jump through hoops to get to. And then always keep at least $500 to $1,000 in a savings account for immediate ability to withdraw. For instance, what I originally tried to do with my emergency fund was have $100 a month into a CD with my credit union, because they mature and you can change it out for every 14 days. Whatever strategy a person has, but that emergency fund is very, very important. And to not just have it in a home safe underneath your mattress or into a savings account earning 0.025 or something. Even all that money could work for us as much as possible.
And do you usually, like with the CD, do you do like a CD ladder?
Right, that's a laddering effect, and that's what I mean. So I actually, because Navy Federal was kind of upset with me with trying to have 365 CDs, they asked me, was I an idiot? I was like, okay. And so came up with a CD for the 1st, the 10th, and the 20th, and the 29th, 28th of every month. So 4 CDs a month. And that came out a lot better. It's still 48 CDs, but to say, 500 CD times 48 or whatever, because I'm able to save up for a year worth of emergency. Somebody else might want to start with $1,000 a month. You save up what you can save up, but once you get to, if you got $2,400, then why not a $200 savings account saving bond CD for the 1st and 15th of every month? And then say, okay, you still got your emergency fund and you want to build it up, maybe add $10 or $5 a month to each one of those CDs. You say, oh, I got 24, saying, so if you got 24 and you could save 50, just put $2 a month into each of those until you get the amount that's right for you. Once that emergency fund or those CDs are at the place you want, then the rest of that money should go into long-term savings. But the higher your living expenses are, the higher your emergency fund needs to be. So I'm always contributing a little bit to my emergency fund. So in my budget, and we recommend budgeting every dollar you get. Some people had a problem with that in week 1 when I said that. You budget every dollar you get. That doesn't mean you spend every dollar, but you know where every dollar you get goes. You shouldn't have a budget to say, I make $2,500 a month and my budget comes out to be $2,300, so I have $200 left over.
Right.
That $200. Add it to your emergency fund or your savings. Maybe you say, well, I got $200 left over. My emergency, my entertainment fund is $25 a week. Is that realistic? Do I only spend $2,500 a week? Let me up that to $35 a week, which is another $40. So now my leftover money is $160. Let me add $20 to my investment account. So that takes me down to $140. I'm gonna add another $10 a week to my emergency fund, and I'm down to $100. And I'm gonna add another $100 a month to my savings. But every dollar should say I have a place to go. It doesn't mean you're gonna spend it. Even if I have a $35 a week entertainment fund, I may not spend $35, but that might help me to say, this week I want to go to take my lady out to a movie, and that's going to actually cost me $50, which meant, so my next fund next week I only have $25. And I know a lot of people had a problem with saying budget every dollar, but what if something happens? Like that's what the emergency fund is for. And what most people mean, what if something happens? What they really mean is, what if I'm at the club and I buy 3?
Yeah.
You know, so, and it's all about discipline and knowing stuff like that. But we can budget every dollar, and we should. You should not have to say at the end of the month, there's $200 left and I don't know what I did with it or what I should have done with it. Or I think whatever's left over, I put it, like, that's, if I don't spend it, I'll put it in savings. Well, then just write it for savings. Why do you have this thing if you spend it? If you're gonna spend it, then put it there. Entertainment, if you say, I don't care if you say your entertainment is $300 a week, maybe you'll spend it, maybe you don't, but you know it's not coming from another pot of money. And that's the importance of budgeting every dollar. And that's, I think that's the number one issue we found and so far, is that we do want everyone to have a written budget and to try to stick to it, and to realize that a budget is not a restriction, it's not a penalty, it is a useful tool. As I shared, Warren Buffett has a personal budget, not just a business budget. Bill Gates says he's had one. Bill Gates' families have been millionaires their entire life. He said he's never known anyone who knows to not have a budget. And he's not talking about his budget for Microsoft. His dad was a millionaire. He's a billionaire. He said he has a budget and he reviews it every 6 months. I figure, hell, then my broke ass need a budget. And it has helped me to not be broke. It is the number one financial tool in the world for a reason. It's the number one indicator of financial success for a reason. And Black people, poor people, we tend to not have one. Here in week one, I said, who has a written budget? One person said, I kind of have one. Another person said, I have one for my business. That business is not even doing well, and that's not your personal budget. And another person said they did have a budget. So I think week one, we had like 11 people, and there was 2 of us who had a written budget.
You got me some food. You got me some food, sir. He's on the phone.
Chris shared last week that Google Cloud and so forth, they do budgets online for free that you can use their software to help you with it. I use an Excel spreadsheet. Whatever works for you, we do. I keep harping on this. I cannot stress enough. Write a budget. Get yourself to the point that you're allocating a minimum monthly amount to your budget, to your investments, to your savings and your emergency fund out of that budget. I contribute money to my Ameritrade account weekly, just like my son said he does, because that's easier for me to manage. Some people might do it monthly, and if you might do it automatically, and we do recommend in that budget is paying a lot of your stuff electronically and knowing the difference between you sending the money out of your account to those people rather than letting those people go into your account. Definitely, you control your money.
Hmm.
All right. So I see it's down to just the three of us. Do you have anything you want to put in, Lamar? All right. So I'll be conducting a hypnotherapy appointment with someone at 11. So I'm gonna take my leave because I want to have an opportunity to have some breakfast before that. I appreciate everyone who was here this week. I recorded it. I'm gonna see. I've never recorded a Zoom meeting before. I'm gonna see. I don't know if it's available to the participants or is they're gonna give me a link that I send out that people who were not here or who were here and just want to review it can. Again, I appreciate everyone who attended. I'm gonna meet next week. We've been meeting every week at Saturday from 8 to 10 Pacific Standard Time based on your location. Obviously, you know what time that is. Next week is Real Estate Investment Trust. We're also going to evaluate a Charles Schwab Emerging Market ETF. And we're going to presuppose what we're going to invest in for July. I'm going to go back to my post on Facebook and write in there that I am recording these meetings. Some people are sensitive about that, particularly if they're live on the video instead of just, I see some name monikers. And so people can feel comfortable and there's disclosure of that. Again, appreciate your attendance. Hopefully you'll see you here next week. And this will be a continuing thing weekly for the remaining of the year. For the remaining of the year, not just because this was supposed to be a 1 month thing. And there's a wealth of knowledge of everyone who's joining this and keeping this conversation rich and informational. Each of us is giving of our time freely and trying to help each of us come up together individually and as a group. And that's a blessing that we can all keep giving to each other. Again, thank you all for this week, and I'm going to be closing out for now. Bye.
All right. Thank you.
You're welcome.